Welcome to the latest monthly analysis for the month of May with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. How are you, Andrew? You well?
I'm very well, thanks, Dan. Yeah, good win for England at the cricket.
Very good win. Joe Root doing very well.
Yes, and
stepped down.
Indeed, it took a lot of pressure off him. I think that so it was a good move.
That seems to be working, doesn't it?
It certainly does.
See how it goes when you play against Australia in the Ashes. But enough about that. So we're here to once again just talk about the funds and I guess just how everything's been going over the previous month, which is May. So if you want to give us or clients a full analysis of how things have gone, it's not been too rosy.
Well, we started off, I think, with the good news, which was England won against New Zealand, the first test. But apart from that, yes, it's not been a very good month, May, at all for any of the sectors, really, that we invest in. In fact, all the sectors over the month of May were down in value and down quite steeply again. So for this year, we've had big drops in value in January and February. March was up, April was so-so, and May has been another steep decline. And the reason for this is all to do with COVID and the amount of money that was pumped into the economy by central banks throughout the world, basically. And also the fact that we've now got lots and lots of people that are out of lockdowns, out of restrictions, and are wanting to do things. And this involves spending money. And unfortunately, the supply chain is still badly affected. And it has an impact on all sectors of the economy. And what we look for really when we're designing our portfolios is nothing to do with the short term, because short term we can't change things, we can't make a difference really. It's more the long-term success that we're interested in. So these updates, although they're fairly depressing so far this year, we apologise for that. They're not really the part of the bigger story, which is making money for our clients over the medium to longer term. And the medium term, we mean anything about 3 years and above. Anybody investing for less than that is always a bit of a gamble. Are we going to have more money than we do this time last year? Will we have more money next year, this time, etc., etc.? And for that, we just don't know. But long term, we continue to make money.
So, Andrew, what would be the major events worldwide that occurred throughout May then?
Yeah, the real big one, I think, was the Federal Reserve putting up interest rates, and probably more to come on the back of high inflation figures in America. Bank of England continued to raise rates here, again on the back of high inflation. The ECB, the Central Bank for Europe, they're continuing to maintain the negative same interest rate that hasn't increased at all yet, despite high inflation in the Eurozone. So I think Europe are a bit behind the curve in terms of what we've been doing. Quantitative easing here in the UK was ended around about December of last year, and in America just within May. That's when it's all starting. So a contraction then of the money supply, which is aimed to then reduce that liquidity around the world, which will then hopefully dampen demand. Now, whether it does that or not is, I think, debatable, because I think demand is still there. You know, it doesn't matter really what interest rates are put up to. If you don't have a mortgage, you don't have debt, it can go up to any amount. You're still wanting to move home, you're still wanting to buy, you're still wanting to go on holiday, eat at restaurants, and do all the things that we've been used to doing pre-COVID. So no amount of interest rates will damage that. But short term, it does affect people on the breadline, which is why the UK government announced measures to ease the impact of higher prices on low and middle income families here in the UK. China's got the reverse situation where they're not so bothered about inflation. It's more to do with zero COVID policy and lockdowns. So Shanghai, month 2, still in lockdown, going to be ending that hopefully soon, but it does have an impact on the world's largest exporter. But interestingly, I think exports from China were up, which surprised market analysts for this period. So it's a very, very it's a strong story about consumer power in America, for example, I think there's around about $2 trillion worth of excess savings there ready to be spent. But it's the old story about demand exceeding supply. And until that improves, then we're still going to have inflation at high numbers, certainly to the end of this year.
So the question is, Andrew, is there an end in sight then to all of this?
To the doom and gloom? Well, probably not in the next 2 or 3 months. What the markets need to see is inflation either coming down or certainly not rising to the levels it has got to at the moment. During May, the inflation numbers that came out for most of the world were above estimates, which was a bit of a worry, which caused then another sell-off. Because if you're holding an asset and that asset is not making money against inflation, then you've got to judge how long to hold it before you actually say enough's enough. And I think that's the final straw came this month with analysts saying, well, look, if the inflation figures are not coming down, they're still going up, then we're going to have to get shot at these assets that are not able to keep pace. Once we can start seeing inflation's peaked and come down, then we're going to get a better a better run for our money. And that's probably not going to be here until probably towards the last quarter of this year, because the big input figure to all the inflation figures around the world, and it has to be said, it's not just here in the UK, tune into most news channels throughout the world, and it's the same story. The price of fuel increasing to record highs, and the price of keeping your home warm and lit is extraordinary compared to what we've been used to over the last few years. So it will take a wee while to come down, but once we've got the autumn winter fuel inflations through the system, which will probably come to around about December of this year, then markets, if those numbers are looking good, will start to rally again. Fundamentally, the funds that we choose and select carefully for our clients are full of really, really good assets. So unfortunately, the last few webinars have been doom and gloom in terms of short term, but long term, we're still making money. And that's the important thing to consider. So we're all in this. We're all best placed for the recovery. And we do feel it with our clients. Our own pension funds are invested in exactly the same funds that we're choosing.
Okay, so Andrew, so what else could potentially aid the speediness of the recovery then?
Well, the big one for Europe in particular will be the war in Ukraine coming to an end. Whether that's likely or not is debatable short term. Exports picking up from China. So the latest export figure showed an increase, which surprised many analysts. And production, I think, improving. So again, COVID is still causing difficulties throughout many workforces. But if that starts to fall, it probably will over the summer months, then absenteeism, easy for me to say, rates start to reduce. So we could see the supply chain getting back to somewhat like the levels it was before COVID. And that would improve the situation as well.
And do you think it would be a sort of a sharp recovery in that aspect? So obviously it could happen overnight, or do you think it's going to be a prolonged, or because I know that markets fluctuate up and down very quickly. So what's your thoughts on that?
Well, they do. I mean, bad news is priced in very, very quickly. So the speculative investor who wants to try and make a return over a short period of time is very sensitive to anything of a negative effect. More positive news, I mean, if the war suddenly finished overnight, that would send an immediate boost, but it takes for the supply chain to get better, to ease. It's not going to be overnight. But we can see things like timber, chip manufacturing is coming back. A lot of car producers are saying that they're able to get cars off the production line quicker. So it is starting to improve. And again, it's not overnight though, but gradually, bit by bit, we'll see it. And then we'll look back and we'll look at the performance figures and go, oh, crikey, the markets have gone up quite a bit. And for those investors that aren't actively involved within the market, they miss all that uplift in investment value. So the key at the moment is stay strong, stay invested, because that's where the profit's made. These are hard times, and they're always hard times when we go through a dip like this, and we do feel it for clients, and we do all we can to try and mitigate that with the number of reviews we do, and just sort of being here to be on hand to answer any questions we possibly can. But for most people, it's stay investors, stay committed, because long term that's the solution. And I think it's interesting to look at the figures over the last year or so, and we actually see that the best performing assets have been those which have got the equity component, the share component within them, and the investments which have fared worst have been the lower risk assets, the fixed interest, lending money to companies, lending money to governments, which haven't fared that well at all. And that's why we've been sort of the last 2 or 3 years now encouraging as many people as possible to review their portfolios and to perhaps look at increasing equity content, because actually that's a safer option for many people.
Stay the course, trust the process. And now we'll go through the performance of the A.R.D. consultancy portfolios over the last month, year, 3 years, and 5 years. We'll start with the defensive portfolio. Over the last month, it's -2%. Over the last year, -5.3%. Over the last 3 years, up 3.8%. And 5 years, up 11.4%. Our cautious portfolio over the last month is -2%. Over the last year, -4%. Over the last 3 years, it's up 8%. Over the last 5 years, it's up 18.9%. Our balanced portfolio over the last month is -2%. Over the last year, -3.9%. Over the last 3 years is up 13%. And over the last 5 years is up 28.1%. Our capital growth portfolio over the last month is -2.3%. Over the last year, -3.2%. Over the last 3 years, up 15.6%. And over 5 years, we're plus 37.8%. And finally, the aggressive portfolio over the last month is -0.2%. Over the last year, -1.6%. Over the last 3 years, plus 24.91%. And over the last 5 years, plus 49%.